and welcome to the latest Retire Well episode with myself, Matthew, and as always, I'm joined by Joe. Today, we're thinking about the new tax year. So first of all, happy new tax year, Joe.
Happy new tax year, Matthew.
Perfect. So today, what we're going to think about, we're thinking about what people should be looking at for themselves, whether they're approaching retirement or in retirement, thinking about things like personal allowances and what they should be doing. So first of all, Joe, I'll throw it over to, is there anything that's been in the recent statement from the Chancellor that anyone should be thinking about? Should be quite a quick one.
Yeah, it should be quite a quick one. I mean, there was only really a couple of things rumoured. We didn't get the usual pension, I suppose, pile-in, which is saying that they're going to reduce tax-free cash, state pensions are going to be means tested. It was all very quiet on that front. The only thing that was potentially rumoured was that they were going to reduce the £20,000 ISA allowance that you get for stocks and shares and cash ISAs down to £4,000 for cash ISAs only, while keeping the £20,000 available for stocks and shares. I suppose the why they were looking at that, they wanted to sort of increase investment in the UK, but it pretty much didn't come about, and nothing was really mentioned. So maybe that's one to look at for the next autumn budget that comes round. But in terms of what's changed going into the new tax year, nothing from the spring statement. We're only really looking at changes that were already detailed and we've known since that previous autumn budget, some of which will come through today. Before we run into them and run through them, because it is quite numbers heavy in all honesty, I thought it would be good to start with, I suppose, the softer sides of the new tax year and what we could be doing in terms of essentially sitting down and almost looking back, where are we at and what do we need to go at in the future. Matthew, do you want to lead with that on sort of things you might be able to think about going into the tax year?
Yeah, I think some people ask us when's the best time to retire, and they think we'll say the start of the new tax year. Again, the answer tends to be when you're psychologically ready and when your financial plan aligns with the income you want to take. But for argument's sake, if someone's just retired and they're about to start taking some pension income, for example, what are they thinking about? They're thinking about, how can I minimise my tax and how can I maximise all my allowances? So the first one for someone to think about is that personal allowance of £12,570. That is frozen for another year. So again, in a way, with inflation and that sort of thing escalating, that is a bit of a stealth sort of tax. But in general, someone who's just started retirement should be aiming for at least £12,570 worth of taxable income from a pension, for example, and then any other income that they're looking to take, they could think about taking that from tax-free cash, which can be drip-fed, and potentially taking it from other sources such as ISAs or cash accounts. You mentioned that these would be sort of numbers heavy. Again, someone who's just starting the new tax year, who's still working, should be thinking about where they fall in the scale of income and whether they can afford to make additional pension contributions to bring their tax down. Do you want to sort of fly through the allowances and just where people should be thinking on that scale?
Yeah, absolutely. So Matthew said there, all thresholds have essentially been frozen, and it's likely to be the case for the next few years. Yeah. It almost, I suppose, acts like a little bit of a stealth tax, some people say, because although the tax rates have stayed the same as people's incomes naturally go up, there's more tax take from the government. But as Matthew said, personal allowance remains at 12,570, which means your basic rate band essentially is anything between that 12,570 and 50,270, and then above that you'd go into higher rate, which is taxed at 40% as opposed to the basic rate of 20%. That's essentially between the 50,270 and 125,140. And then after that, you jump again into additional rate tax, which is anything above that at 45%. Unfortunately, it's actually been publicised recently that the £100,000 tax trap, which is at 60%, is still in place, which is essentially whenever you start earning over 100,000, you start to lose some of your personal allowance, which essentially means instead of getting taxed at 40% as you should, you're taxed at 60%. And we'll talk throughout this episode a little bit about how you might be able to help with that on reducing your income through other means while still benefiting from pensions.
Yeah, so I think going through those allowances, anyone who is at a point when they've got a surplus income and they are above one of those income thresholds, so if you said anyone above £50,000 who is saving on a regular basis, just building up money in cash, could say, I'll make additional pension contributions to essentially bring my adjusted income down and get me back to only paying 20% tax. And then the no-brainer that Joe said there is anyone earning over £100,000 should definitely be thinking, can I afford to sacrifice some of my income in order to put money back into the pension and save on that 60% sort of area. The fact that someone can put £60,000 into a pension in a tax year gives you that complete threshold that if you were earning £120,000, you could put in certainly the £20,000 to get you to 100. In theory, you could put a lot more in and get a lot more of that tax saving back as well. So it's a really, really tax efficient way to think about pensions and saving for the long term.
Yeah, I think outside of sort of the main thresholds there as well, it's probably worth mentioning over £100,000 you can lose out some of your free childcare, which again it's another hit when you go over that £100,000, and then equally if you're into the higher rate tax bracket but earning between £60,000 and £80,000 and you've got children, you'll actually start losing or actually have to pay back some of your child benefit. So again, that's something where it's probably good to look at it at the start of the tax year if you've had any potential wage rises or salary increases, or you expect to get a bonus in the near future, just to sort of plan ahead. I mean, we've got 12 months to the end of the tax year, so there's plenty of time to look at that, but just want to be thinking on sort of what do we need to do, what can we do to potentially not be paying as much tax as we should.
Definitely, and I think why do we think about it now? I think the easier thing to do with a pension contribution is to think about those monthly contributions. So we have lots of people who get to the end of a tax year and say, I need to put in a large number to help manage my tax. If you can actually start that process with some regular payments throughout the tax year, that can actually help because it avoids that psychological thing of having to write a cheque for £60,000 or to do a bank transfer of £20,000. If you do that on a monthly basis, it just comes out, it's a bit more tidy and it's a bit sort of easier psychologically.
Yeah, I think it helps from sort of, I suppose, that psychological basis of not having to write it out at the end of the tax year, but B, from a practical basis as well, it can actually help reduce the risk of the pension contribution, because if you put in, and this year is actually probably a great example, if people are getting towards the end of the tax year in the last month or so and they've gone, well, I want to put 40,000 into my pension to make sure that I'm not going into these higher tax brackets. Yeah. They may have put a large lump sum in towards the end of February or sometime beginning of the calendar year, and the sort of market performance that we've seen over the last month has been pretty poor due to Trump getting his tariff hammer out. I've been calling it, I'm sure Matthew will have a laugh at that, but essentially having tariffs on, tariffs off, causing a lot of uncertainty in the market, and we've seen quite poor performance in markets. Whereas if you look at it at the start of the tax year and say, well, instead of putting that 40,000 in all at once at the end of the tax year, and you spread it across the full tax year in monthly payments, that can help take a little bit of those ups and downs out as you buying some at a cheaper rate if it's gone down and some at a higher rate. So I think that's one thing that I suppose is a nice tidbit that most people might not think about.
Yeah, definitely. So start of the tax year, you might be thinking about how much you're going to put into a pension and what your income is going to look like. One thing to mention there is we're thinking about employment income. If you were retired and you had pension income and you had, say, rental income, again, that wouldn't count for your funds that you're able to put into a pension. So you've got to be a little bit careful with your calculations. But certainly, as we move into the new tax year, thinking about what you expect your income to be, what you think your tax is going to be, what assets you've got, in bank accounts, ISAs, other things can help you with that overall picture. One thing I've had a few clients get in touch with recently is tax coding notices for the new tax year. One of the sort of new things that haven't been that common in the last few years is that section where it says untaxed interest. If we rewind sort of 3 or 4 years, bank accounts paid next to nothing, inflation was really low, and people were, had money in the bank, and it was purely for spending rather than for saving. As interest rates have gone up quite nicely, people might be earning more and more interest. At the same time, those allowances that people have got have been squeezed. So more and more people have got what's called now untaxed interest, where the bank account has paid the interest out, and now the government are looking through the tax system to say, can we reclaim some of that tax that should have been taken? So another thing, as well as thinking about your pension contributions, is to look at your tax code and say, is it right? Some people who I've spoken to think the numbers have been incorrect. I had someone who sold a property, so they had cash in a bank temporarily. Again, it might have been that was the time then when the banks were telling HMRC how much interest people were earning, and therefore that individual, it looked like he might have had more interest going forward. In reality, that money went back into another property, so he had to get in touch with them to make sure his figures were correct. So I think that's another really strong point, just to make sure your tax codes look correct and whether there's anything funny like untaxed interest.
Yeah, I mean, sticking with the theme of banks and savings income, it's probably a good time just to sort of refresh on what allowances you have on savings income. So if you're a basic rate taxpayer or below, you get essentially £1,000 saving allowance, and high rate and above it's 500. If you are, although a non-taxpayer, so you earn under that personal allowance of 12,570, you also get an additional 5,000 starting rate for savings, which you can essentially use for savings income. So there's potential that you've got, I mean, almost £18,000 of savings income, that if you don't have any other income is essentially tax-free. So that's one that we can look at. And I suppose in the same vein, looking at those allowances, in the same sort of vein, it's mentioned about the capital gains tax allowance and the dividend allowance, which, I mean, I suppose say a prayer that it wasn't reduced again this tax year, because the past 3 tax years or 2 or 3 tax years, we've had it come down, capital gains from 12,000 per person all the way down to 3,000. So we've already been squeezed on that point of view, but it stayed the same at 3,000. I suppose keeping it at 3,000 and the dividend allowance at 500, Matthew, does that limit people's investment opportunities when it comes to sort of how they might invest, or what other options are?
I think I wouldn't say it limits someone's options. I think you're being taxed on a gain when it comes to capital gains tax. So again, that could be frustrating when you could have the gain inside products where there's no tax, but because you're being taxed on a gain, you are being taxed on growth. And the dividends allowance, again, it applies on a personal portfolio, but you can invest in ISAs, you can have money in pensions that doesn't count, and you can also have things like investment bonds that can be tax efficient. So I think almost on a piece of paper, having your various pots and having what is taxable and what isn't taxable can almost prompt you to think, how do I squeeze the tax efficiency out of my situation? Using your ISA allowance now that we've rolled into a new tax year makes sense. For years, cash ISAs were a bit of a con, where you should really have had them in investments for the long term. Again, there's a bit more interest rates available now, so if someone was a low risk individual, they should be moving money across from a normal cash account to a cash ISA. And if they've got any investments in a personal portfolio, they should be thinking about moving those to ISAs for the long term.
Yeah, you mentioned personal portfolio there. Just, it can go by many names, I suppose, just to make sure we stick out the jargon. It could be personal portfolio, general investment account. Essentially, it's
unit trust and OIC.
All sorts. Essentially, it's any investment account that doesn't have a tax wrapper around it, like an ISA or a bond or pension. So that's essentially, if there's any growth within that, or if there's any income or interest, it's essentially taxable. Where if it's within an ISA, it can grow tax-free. Anything that you draw out of it can be tax-free. And ISA allowance is 20,000. It's very much a use it or lose it. If you don't use it in the current tax year, then you won't be able to put 40,000 in the next tax year. I suppose this is probably more of a thing to look at towards the end of the tax year. But a newer ISA product that's come along is flexible ISAs, Matthew. I think we were speaking earlier, if you want to just run through about how they might be able to be used and sort of what options they give people.
Yeah, so a flexible ISA, people don't always understand it, and I understand why they wouldn't, because not all ISAs are flexible. But you can have a flexible ISA where if you take some money out in a tax year, you've also got the ability to put money back in. So I've had people who've got invested ISAs worth, say, £200,000-300,000. They might want to buy a bungalow that they've seen, so they might want to use some of that money towards a house purchase, and they expect to then sell their first house, and money might come back through the system. So they can almost borrow from this ISA account, take it in the tax year, use it for their transaction, and then they've got the ability to put that back in as long as they do it before the end of the tax year. So that can be really powerful, and we've seen people use that to their effect. So again, like you mentioned, it's usually with ISAs, it's use it or lose it. And it used to be, okay, I've taken £200,000 out of a pension, I've got some money to put back in, okay, I can only put 20 in, that's a bit frustrating. The flexible ISA, 200 out, 220 could actually go back in because you've still got your allowance to use as well.
Yeah, absolutely. And I suppose sticking in the ISA family, just to sort of look through what other options you have available there. So the 20,000 applies to all of your personal ISA accounts. You can also, if you do want to invest in a lifetime ISA, most people know this in terms of you're saving for your first house. Yeah. So for every 4,000 you put in, the government top it up to 5,000 with an extra 1,000, and that can be cash or investment. I suppose the big one here, it can be used for retirement, but there's a penalty for accessing it before age 60, and we're seeing a lot of people wanting to take cash out earlier than age 60. And if you do take money out, it's a 25% withdrawal penalty, which might seem like you just get out what you've put in, but essentially it actually works as if you've put in 4,000, you get 5,000 after your top up. Yeah. Once you take it back out, you actually only get 3,750 back out. So it's essentially a 6% and a bit withdrawal penalty if you do that. So it's not something we do a great deal of. We don't necessarily see. What are your thoughts on that, Matthew?
I think a bit like the Help to Buy ISA, people who are putting it towards their first property, it makes complete sense. If for whatever reason, it doesn't go towards the first property, then you're in a bit of a funny limbo where an ISA, for me, an ISA is that short to medium term where you could say, I might leave it invested for 10 years or 20 years, but I might use it after 5. The idea of the LISA saying, okay, well, if at my age, am I leaving it until 60? Well, if that's the case, I would rather put it in a pension. I know I can't take money back from a pension, but do I really want to take money back from this LISA and be penalised? So it's almost that element of, first-time buyer, getting the benefits. Yes, person who's saving for retirement, stick to the traditional product of a pension is my opinion. You might have a slightly different take on it. Or?
I'd say I'm pretty similar, to be honest. I'd say there's probably a very, very, very niche client where it might make sense to invest in a lifetime ISA, but you don't get the benefits of the tax relief to help you reduce your income, which is one of the big benefits of a pension. I suppose if you're a non-taxpayer, you might be able to get that additional uplift and not pay any tax on the way out. But I think for the main part, pensions will do that job for you, and a LISA, I suppose, is a bit more of a niche product.
Yeah, and also just in the same way that we're thinking about ISAs in general, you've also got junior products, junior ISAs, junior SIPs. Again, we see some families who maximise their children's allowances to save for the future. Again, it depends what you think your children will do with the money, how it comes across, how it's educated, and what you're looking to do. And I think there's almost that focus of make sure you use your own allowances before you drip feed for your children's allowances, because you having more financial freedom and flexibility can help you provide for your kids anyway.
Yeah, I think junior ISAs again, they can be really good, especially if they're invested. We ran through in sort of previous episodes about what's the maximum junior ISA that's there. I can't remember off the top of my head what it is. I think probably one thing to point out on this, which I suppose a few advisors in the space have been talking about recently, is if your child's got special needs and whether or not you should invest in a junior product like a junior ISA or a junior SIP. Mm-hmm. If they need to use care for whatever reason, I think it's sort of 23,500 above that, then they're going to have to be sort of self-funding, or below that for other sort of care. If you're investing in a junior ISA or a junior SIP, ultimately your savings might go to the state. So in those sort of cases, I'd say definitely seek financial advice to make sure that you're looking at it correctly. And in that case, it might be better to keep it in your own name until you need to sort of pass money on to your child.
Or even trust planning, I think, could be very important at that point. So again, professional advice, legal and financial, makes complete sense.
Yeah, absolutely.
Definitely. I think in terms of wider allowances, you might also say you've got to a new tax year. If you've got assets and you're of a certain age and you're thinking more about estate planning and care home fees and that sort of thing, you might start to think about your gifting allowances. Again, we know there's a £3,000 sort of annual gifting allowance, and if you haven't used that in a previous tax year, you can double that up. So it makes sense to think about that and divvy it out, especially if you've got assets that are growing over time. The other one that we've talked about previously is gifts out of surplus income. Again, it might be a good time to write down your income for the year, what your expenditure looks like, possibly looking at last year's tax year, and then say, I'm able to allocate gifts out of surplus income of X. Document it accordingly so that if it ever was challenged, you know why and how you've got to that figure.
Yeah, and I think the documentation's key on that sort of gifts out of normal income. It's not an allowance that you claim when you gift it, it's an allowance which is claimed when you pass away. So if you can make sure that your executors are fully aware of what gifts were made and when, it's much easier for them to essentially fill out the form when they're looking at it from HMRC. And the other one that I'm sure Matthew was about to mention, but I'm going to steal his thunder on that, is I suppose lesser known allowances for gifting. So gifting for weddings is one most people will probably give a wedding gift. But if you are actively thinking about sort of the estate planning side of things, you could maybe gift above and beyond what you normally gift for a wedding. So for children, you can gift 5,000, grandchildren 2,500, and then any other person 1,000. I'm not going to say just go to random weddings and start giving away £1,000 here and there, but
for anyone who wants to invite Joe to a wedding, you're very welcome to.
It's not on the cards just yet, but we'll see, and I'll put the invites out. I think in terms of gifting, new tax years come round. The other final thing I suppose about gifting that we should talk about isn't necessarily an annual allowance which you have, but it's almost a 7-yearly allowance of how much you can gift in one tax year without it becoming a chargeable lifetime transfer. Not going to go deep into that today. We'll probably save that for a new podcast, but that's just conscious about if you are going into more complex estate planning, gifting into trust, that's one thing that you should maybe look at.
Yeah, I think if someone was really geeky in this area and was really taking the new tax year seriously and was thinking about all the allowances and their income sources and the gifts and things, you might say, what have I given in the past? How far am I through that 7-year cycle? What am I giving in the future? When do I intend to do it? And again, it's a really key area to get some formal advice because there's some easy mistakes to make in that space.
Yeah, I mean, speaking about being geeky, I'll say I'm guilty for this one. I think this new tax year specifically is probably a unique opportunity where a lot of you could maybe speak to your employers about increasing pension contributions. So we've spoke about how you want to sort of add more into your pension. If you're over a certain tax allowance, it'll bring it down. One thing that you could do within an employer pension, if you are employed, is look at salary sacrifice.
Yeah.
I'd say the vast majority of employers are favourable for it because they save money.
But it's not always as clear cut. I think it really can be a lottery depending on when the pension was set up and what the employer does. But
but the sort of the unique side of it I said today is at the budget announced we were going to the government were going to increase employer national insurance from 13.8 to 15% as of the new tax year. So if you've been interested in salary sacrifice previously, essentially you forgo your salary and it goes straight into your pension. And if you've got a particularly favourable employer, they'll contribute that employer national insurance saving into your pension. So if you're saving them more by doing it, it might be a good time to almost reopen that conversation and see if it's something that you could explore.
Yeah, and certainly even just from a personal level, just to check, what are you putting in? Could you put more in? Makes complete sense. The more you put into the pension, the more it's going to be worth in the future, the better retirement you'll have, and the less tax you'll pay as you go through your employment journey. So yeah, no brainer there.
Yeah, absolutely. And then Matthew, do you want to just chat briefly over sort of carry forward allowance? Again, it's not necessarily something that's limited to one tax year, but something that you could look at with it being a new tax year.
Yeah, so when we talk about pensions and we say £60,000 is the amount that someone can put in, potentially you can roll that back for 3 tax years of any unused allowances. So again, you could be looking at quite significant contributions. Certainly plays well for business owners who can potentially put in a large amount as a company contribution, and for those individuals who are looking to maximise their own personal savings, just looking at what they've put in previously and what they're going to use going forward.
Yeah, absolutely. And then final bit on pensions, I guess, before we sort of move on to questions and going forward. One thing that Matthew briefly touched on as well there is if you're a non-taxpayer or you don't have any earnings, you still can contribute to a pension, which I suppose is a misnomer that not many people know about.
Yeah.
You can contribute £2,880 to your pension. Government top up £720 to bring it to £3,600, and it's just a nice, easy way. We find it quite a lot if we've got one client that has got a lot in pensions and one client that maybe doesn't, and they're married. Potentially, it's looking at trying to equalise that level and make sure that not that the pensions have to be exactly level, but allowing you to have two allowances when you're drawing down on them. That can work quite well.
I think that it makes complete sense, and it squeezes an extra £720 from the government. So again, people like that tax planning. Definitely.
Yeah, I mean, me and Matthew were speaking to a client just last week where coincidentally they were actually wanting to draw around 270, I think it was 250 from their pension per month. So by doing this and contributing to your pension, although it might seem strange to contribute to your pension while you're already drawing from it, they've essentially given themselves a free month of income from the government. And if you can get the government to pay you a free month of income, I think most people would snap your hand off.
Yeah, definitely. So I think we've covered most of the common, allowances and things to think about. Is there anything else that we wanted to almost go through before we wrap up today?
So I suppose the only thing that I wanted to mention before we sort of jump into a question or two is with regards to the state pension. So triple lock is in place. It's gone up to £230.25 a week, which is just under 12,000 when you convert that to an annual basis if you're on the full state pension. And I suppose it's not necessarily an issue now. Maybe next year it's the thing where the government are going to have a look at it, because it's very soon that state pension is going to go above the personal allowance, and potentially you're going to be paying tax already on your state pension before anything else.
Yeah, especially with the triple lock, we do have lots of people whose pension, state pension has gone above the personal allowance, and if that's your only source of income, it's paid gross, and you would technically have to do a self-assessment tax return. So that, George Osborne didn't think about that when he stood up and said state pensions are always going to be paid gross, and no tax taken. In his head, or his advisors probably thought, the allowances will always keep pace, so therefore we're going to have no problems. Fast forward to here we are. It doesn't look like such a good decision to say that now, when someone might have to do a self-assessment just to declare a couple of £100 of tax because their state pensions just crept above the personal allowance. Again, like we've talked about with everything today, looking at your income, looking at your sources, you can be adjusting, what you can take flexibly. I know you can't adjust your defined benefit pensions or your state pension, but you could adjust your drawdown or take different amounts of money from ISAs or other products in line with those allowances.
Yeah.
So it's worth factoring that in.
Yeah, it might be the case. Quite a lot of clients like to draw flexible income up to the personal allowance. So if they've either just started getting the state pension, or B, their state pension's gone up like everyone else has, might be a good time to review that. Or are you paying tax that you don't need if you don't necessarily need the income?
Yeah, no, I think that makes complete sense. And I think, again, it's that benefit, the state pension going up, your income sources are there, factoring in what you think you'll spend in the year, and you might give yourself, more options to save, or you might almost say, I'll draw less income from various pots.
Okay, great. So I think we'll end with one question, Matthew, for you to start off with. This was actually a comment on one of our recent podcasts with regards to tax-free cash and whether they should move it into ISAs. And with the new tax year coming around, they're asking, should they take 40,000 of tax-free cash from the pension and essentially contribute 20,000 to themselves and their spouse's pension, spouse's ISA, I should say.
Yeah, okay, it's an interesting question. There's a few pros and cons to weigh up. Tax-free cash, as you might think, is tax-free. And then ISAs are also tax-free. So you almost say it's a very similar environment. Currently, a pension is outside your estate for inheritance tax, where an ISA would be inside. Again, we know that rules are changing, so that is going to equalise. And then you've also thinking about, you're taking that, and it used to be, you might be crystallising a portion of your lifetime allowance. Again, now that the rules have changed a little bit on that, there's less of a desire and a need to do that. So really the one you might be saying is, you get some growth on that pot, so having it in the ISAs and in your head allocating what it's for, that might be a sensible approach. But from a sort of tax position, it's very, there's not a massive benefit from doing it, but there is a benefit from taking tax-free cash from someone's pension and then potentially putting that into a pension contribution for the spouse, for example. As Joe's already mentioned, you can squeeze the tax efficiency from that pension contribution, so that makes sense. And otherwise, it depends on your wider circumstances of what you're looking to achieve. People do like the idea of allocating pots in their head, so there might be that £40,000 might be allocated towards a wedding, or might be allocated towards a new car or some holidays. So it might be the logistics work out perfectly for someone to say that is then my pot towards something, but from a tax point of view, they're fairly balanced, unless there's any other points that you think you would add.
I think it's pretty much a zero-sum game at the moment, with maybe more weight towards the pensions, given that they are currently outside of the estate. Just to sort of, I suppose...
One other thing I was just going to say there is, when the threat was always that the Chancellor was going to change tax-free cash, so in the past it was almost been a drive to, if I use it now, then if they change the rules, that's not going to disappear. So I think if you go back every time, budgets and other things, and the rumours have been there, people might say, oh, well, I feel a bit safer about my ISAs than I do about my tax-free cash that's still in the pension. So there's one trade-off, but I think you want to say something sensible next.
Yeah, you maybe throw me off, and it might not be as sensible now. No, I was just going to add, with regards to when you mentioned about drawing out of the pension to then contribute more into a pension. Obviously, it can make sense with sort of doing that with a spouse. If you're doing that to pay back into your own pension, there's a bit more of a grey area with tax-free cash recycling. That's something where I'd say, if you are thinking of doing that, speak to an advisor to make sure that you're not tripping up.
Right, if you're thinking about tax-free cash recycling, then don't do it.
Well, yeah, exactly. But it's make sure that you know the rules and what's there. And I suppose the only other one on taking cash out of a pension or money out of a pension to contribute to an ISA, if you were to take more than the tax-free cash out and actually start drawing on taxable income, that can have some implications with regards to triggering the money purchase annual allowance, which we spoke about in previous episodes, which essentially limits the amount that you can pay into your pension going forward. So something to be aware of, and I think a good question, to be honest. I think we get that quite a lot. And I mean, if it was me, I'd keep it in the pension, not because I've got 30 odd years to access my pension, but I think that where we currently are makes sense.
I think another common area that possibly isn't thought about as much is the idea of taking some money out now and potentially paying 20% tax on it versus taking out in the future when your other allowances and state pensions and other things might kick in, where you might actually be paying 40% tax on it. Again, it all depends on someone's circumstances and what they're looking to achieve. I was debating this with a client recently. They looked at their spreadsheet and almost said, I should be taking some out in the early years of retirement because I've got cash to draw down on other things. And by paying some tax now, I've put money into ISAs. And when I want to use that, when my state pension's payable, I'm then not forced to pay tax at a higher rate. In their scenario, it worked completely. But then there was the unknowns. If that person was to pass away before 75 and the whole pension was left tax-free to their beneficiaries, then you might argue, oh, someone's paid tax of 20% when it didn't have to be paid. Again, we don't know when someone's going to pass away. We don't know how the government's going to change tax rates. So it's all about just having the thought process to go through and make sure the decision at the time works for yourself.
Yeah, I agree. In a similar way, I was speaking to a client who was asking if they should take dividends out this side of the tax year, because at the moment we're recording it before the tax year, obviously for the new tax year, and they were saying, well, I don't necessarily need it out at the moment, but I haven't drawn up to the top of basic rate.
Yeah.
They were planning a purchase in the next tax year, which means if you spread any withdrawals, and it goes for the same with pensions, of taxable income across 2 different tax years, even if you don't need it right now, it can make sense. So I suppose a summary on that is just pre-plan and make a decision on what you're going to do in the future so that you can plan accordingly.
Yeah, and that common one that if I had £1 for every time I've said, don't let the tax tail wag the investment dog. Someone who says, I've got an allowance I could use, but I don't need the money, you're saying, okay, do I use the allowance because I'm going to lose it? But then what do I do with it? And you then sat with, something and you have to move it accordingly. So again, it's more about that forward thinking. The person you're talking to there and the planning is brilliant because it's going, I'm not just thinking about now, I'm thinking about the next tax year, I'm thinking about the year after, and I can plan accordingly. Just going, I've got a week left in the tax year, or I've just opened a new tax year. What do I do? I'll use my allowance for the sake of it, or I'll take my personal allowance for the sake of it, and then sat with money in cash. Again, it can be counterintuitive when you think about the long term.
Yeah, absolutely. So I suppose we'll wrap up there, summarising pretty much. Look at pre-planning, look at your allowances, making sure that you're planning so that you're not getting to the end of March next year and struggling. What we did say, we are going to sort of get a document together for today, because I realise we've run through a fair bit of numbers, just I suppose as a quick reference sheet of what's changing in the new tax year and what your allowances are. Outside of that, thank you very much for listening again. We have new episodes every Tuesday. Like and subscribe, but again, thanks for listening.